Welcome back, everybody, to our 36th episode of Capital Clarity. It is 11:11 a.m. on April 21st, 2026. Market's a little flat today, but so far up on the year after a good week last week with two new all-time highs. So, Rick, how's it going?
Yeah, April's been a lot better. Good. Things are good.
April's been a breath of fresh air, to say the least. So far,
Yeah. Yeah, we're only a few weeks, 3 weeks in now.
Yeah.
How you doing, man?
I'm doing good. We had a good weekend of cleaning up the house at the shore, getting ready for summer.
Yeah, boat goes in the water in about 3 weeks. That'll be fun.
Oh man, the
Sure sign of summer when that goes in the water.
Flyers kicking some butt. Game 2 was last night in Pittsburgh. They're up 2-0 in the series. That was an awesome game. Oh my gosh, Martone's
They won
shot,
two
the
and
first goal of the game. Martone's shot. Oof, that was
yeah,
unbelievable.
yeah. It's been fun.
Love
They
it.
won two in Pittsburgh. That's super rare.
I don't know how far they'll go, but and I'm sorry if I'm offending any Penguins fans, but it will be fun just to see them beat the Penguins. Hopefully, knock on wood. All right, I'm gonna get into it. I'm gonna kick us off here, and Eagles draft or I guess draft in general on Thursday. That'll be fun
I
to
keep
watch.
forgetting that. Yeah, I keep forgetting that one.
So we've talked about this a lot with clients so far this year, and I know this is something you always harp on, that midterm years tend to bottom later in the year and see larger corrections. And then usually, I mean, doesn't have to always be this way, but historically, the return 1 year later from that large correction during midterm years is pretty good. This data is from Carson Investment Research, basically showing years, not every midterm year, but years where there was a severe peak to trough low, and then a very good return 1 year later. And just to pick an example, the last year in 2022, there was a peak to trough of negative 25.4%, 1 year later return of 21%. In 2018, prior to that midterm year, there was a peak to trough decline of 19.8%, and then a increase 1 year later of 37.1%. So all in all, I mean, it doesn't always have to go this way, obviously. But historically, when you look back at midterm election year lows, 1 year later, it's pretty good.
Yeah, look at that. The median gain is 33% and change 1 year later. So it's basically midterm years tend to start a little difficult. We already saw that this year with the war and so on. And then they historically they've finished strong, and 1 year after the low, they've been up 33% on average on median. So that's it's pretty impressive. I think this is every midterm year actually going back to
Is it?
1950 or
I
something.
was just thinking that too. I'm sorry. I saw that it was a short list. It seems shorter than I had expected, but
Yeah,
it
it's
is
every
every
four
midterm year.
years from
You're right. Yeah,
1950 on
you're
one chart.
absolutely
You don't
right.
expect it 75 years of
Yeah,
data to be on one chart like that, but yeah. Yeah.
yeah.
I mean, it's I don't know if we bottomed, which kind of feels like we probably did already. We bottomed kind of early for a midterm election year, but heck, we'll take it. Nothing wrong with that.
Knocking on
Nothing
wood.
wrong with that.
Whole day of knocking on wood. Flyers, the bottom, you say, and hopefully you're right.
Yeah, we'll see. You never know, but it sure feels like it. So,
Yeah.
yeah, we'll take it. If that was our midterm misery, then that's not so bad. All right, so check this out. A lot of people think like, oh, the Dow Jones index and the S&P 500 index, they're just whatever stocks get picked to stay in there or get kicked out of those indexes or any of the other of the thousand or whatever other indexes. It's some magical being that makes this. No, it's humans. It's a group of humans. It's a committee. It meets periodically and makes subjective decisions with some objective numbers backing it up to say what goes in and what gets kicked out. So back in 2020, the Dow Jones Committee got together and said for the Dow Jones Industrial Average, you know what, we're kicking out Exxon Mobil. It's just too old school, and we're going to make room for Salesforce, which is a software company. And since Salesforce is probably the wave of the future. Well, what's happened since 2020 when they kicked Exxon out of the Dow Jones and put Salesforce into the Dow Jones? Exxon stock's up 325%, and Salesforce is down 32%. Again, that's over almost 6 years of time. So it just goes to tell you that, stock picking is difficult. And it even shows you that people that run the major indexes and make those decisions, it proves it's difficult because they botched this one pretty bad. I mean, they basically exchanged Exxon for Salesforce as a bet on the future, and sort of the past showed up instead, with Exxon absolutely blowing away Salesforce.
And what's interesting is I'm sure they were thinking, okay, yeah, it's blowing away Salesforce. How much longer can this last? And then we hit 2026, and you see that hockey stick up to the right in 2026. I mean, my
Yeah.
goodness. And Salesforce, meanwhile, in 2026 is down.
That's
I
a
mean, so
really good
far.
point, because people who are just listening to this, you can't see the chart, but the outperformance of Exxon versus Salesforce happened almost immediately and has persisted. It's not like just the recent spike in the price of oil in the last few months has created this disparity between the two stocks. No, it's been persistent and only got more severe in terms of favorability for Exxon once this war started. So, yeah, wild, huh?
That's interesting. I'm glad you chose that for today. All right, something we don't usually talk about here, gemstones. But I saw this. This is from Bloomberg. Diamond prices are at record low levels.
I
And
saw
for
this.
those of you who are listening and can't see this chart, um, basically saying the price of natural diamonds has fallen more than 50% since 2022 and is now at its lowest level on record. Um, and I know a few jewelers, just from our business and clients and whatnot, and they all say, I don't know if this is true, but they all say, well, it's it could be lab grown, taking over the market, lab
Yeah,
grown diamonds, because this is the price of natural diamonds, dug out of the earth, in caves or wherever they find them. I'm not a diamond expert, but apparently lab grown diamonds are becoming very popular, and if you're uh, from what I've gathered, if you're a tried and true, old school jeweler, you like the natural ones better. But they're really declining in price since 2022.
yeah, they flooded the market with lab grown diamonds. And I know a few jewelers who will say, no, lab growns are beautiful. They have so, I mean, the distinction is where it came from, but other than that, they're really, really the same. So,
I've seen them in person, side by side. A jeweler has shown me a lab grown versus a natural one. I mean, again, I know nothing about diamonds, but they look perfectly the same almost. I
yeah,
mean, but like I said, some jewelers and some people who are jewelry collectors will look at it and go, "It's not the
of
same.
course.
It needs
I
to
don't
come
blame
from
them.
the earth."
Yeah,
Yeah, exactly.
I don't blame them.
Yeah.
I mean, but they're down 50, natural diamond prices down 50% since 2022, and the lowest level on record. That's pretty remarkable. I mean, in a world of inflationary price pressures, to see something like this go down in price, that's simply as supply is overwhelming demand.
If you're getting engaged, I mean, cost wise, now is not a bad time, I guess.
Yeah, you're right. You're right. So a lot of people say, why are stocks, in the face of maybe the war or whatever the next, there's always going to be a next event that's scary or worrisome of some sort. Why are they not getting killed, or they're going up, or just basically hanging in there? Well, here's why. This image I'm showing you from Prof G Media, it's just showing S&P 500 annual earnings growth. I mean, stock prices over time, for better or worse, are driven by the earnings of the companies of those that have issued those stocks. And earnings are really strong. They've been strong historically in the last few years, and the projections for this year continue to get stronger. I mean, we just had quarter one earnings get reported, and they were up almost 14% for quarter one 2026. And Q2, Q3, Q4, the next three quarters are expected to be even higher. Now, we'll see if those expectations get met, but the optimism surrounding earnings is remarkable, and that's driving stock prices.
Yeah, and I had the same chart actually for today from Prof G Media, and you know, like we keep saying over the last few episodes, you can get so wrapped up in the news with the war and everything going on. When it boils down to it, as long as companies are still making money, still making earnings, positive earnings, the long-term trend for the stock market just will be up.
Yep, it will be.
Yeah.
Yeah, over time.
Earnings, earnings, earnings. That's what drives stock prices.
Yep.
Yep. All right. So price changes. Selected U.S. consumer goods and services and wages. So this is basically a chart from the Bureau of Labor Statistics showing the price changes in different categories, basically showing inflation increases or not increases in the 21st century so far. So from the year 2000 to 2025. So if you're just listening to this, hospital services since the year 2000 to the year 2025 are up 281.4%, which is the highest increase out of all of these categories. Second on the list, you could have guessed it, college tuition and fees up 196.7% since the year 2000. Behind that are college textbooks, actually up 176.9% in 25 years. And then more medical services and childcare going in the categories below that. TVs, which you and I have talked about before, TVs have become the most affordable out of all these categories. TV prices are down 98.1% since the year 2000.
That's ridiculous.
That's unbelievable. And I keep seeing it in stores and online. TV prices keep dropping, it seems like, every year, but the TVs keep getting better and better. I mean, think about a TV in the year 2000 compared to today, you know? You can access the internet on your TV today. Meanwhile, in 2000, you needed a VCR to play a movie, you know? That's
Yeah,
hooked up to your
true.
TV. Um,
Toys,
new,
computer software.
yep, cell phone services down 44.1% since 2000. Meanwhile, look at how much more advanced cell phones have gotten. And I mean, I'll just say it. What are the categories? I mean, I haven't listed all the categories, but the categories that have shown modest price increases since 2000 or even price decreases, what's the difference between those and the categories that have had drastic increases since the year 2000? The ones that have been pretty much sideways or modestly increasing or even more affordable, price decreases since 2000, those are the ones that the government's not really involved in.
Yeah.
It's very accurate. I mean, hospital services, college tuition and fees, those are the ones that the government has more of a hand in.
Yeah, I mean, medical costs and education costs have soared, absolutely soared. And the price of TVs, toys, software, cell phones, clothing even are down over the last 25 years. I mean, this chart is based, I love this chart. It's like a ransom note on the economy. It's sort of like all the essential stuff like medical and education is straight up to the moon and expensive. Meanwhile, the blue lines, you know, are basically life's way of saying, congrats, you can afford distractions, but not survival. I mean,
I
go get a
mean,
TV and some software and a cell phone and go have some fun. But if you want medical services or education, it's going to cost you,
just to put that into real life perspective, second on the most affordable list, in terms of price decreases, is literally toys. It says toys
Toys.
down
Yeah.
74.2% in 25 years. Second on the more expensive list, the price increase list, is college tuition and fees, up almost 200% in 25 years. What is more essential, toys or college tuition and fees? Yeah.
Well, I got
It's
something coming up
wild.
on college
Well,
tuition and fees in a bit, so it'll
can
help.
I just piggyback off this again real
Yeah,
quick?
do
So
it.
the one thing that's not on this list, at least I don't think it is, that we've got new cars on this list, but that's the only automobile category on this list. I keep hearing about car insurance so expensive, so I looked into that on my own, separate from this chart, and this is from the Bureau of Labor Statistics. The CPI, the inflation for motor vehicle insurance, is up 56% since January of 2020. And that really picked up after the year 2022. Just an insane increase, in
Yeah.
my opinion. And yes, I get it. Cars these days are fancier, more bells and whistles, safer versus cars made 10 years ago, or especially 20 years ago. But still, that number, 56% in 6 years, is pretty insane.
Yeah. I think a lot of people forgot how to drive when COVID hit. And
Maybe.
I'm guessing, maybe accident rates went up too. Yeah. Wild. All right. Well, so good news if you need to spend money on medical services or education or just want to buy toys. Um, Let me see if I can share. There we go. So this image from the New York Fed shows the number of consumers with new foreclosures and bankruptcies. And it is very, very low. It's very, very low by historical standards. I mean, where we sit today on a relative basis to history, very few people or companies are going through foreclosures and bankruptcies. This chart goes back to 2003, and you can see right after the tech bubble burst and even before the great financial crisis, we had a lot of bankruptcies surging during the early 2000s. And then, of course, the great financial crisis hits between late 2007 and early 2009, and the foreclosure number goes straight up as well, exactly what you'd expect. But ever since then, both of these have been trending lower, and we're still kind of in that phase right now, at least so far. So that's actually a really good, another piece of good news. So it kind of
It's a good
also,
sign for the economy.
it is, and what you just said makes sense. It flows right into the corporate earnings thing. I mean, if less people are under financial duress comparative to history, they spend more money. More of that money goes into the earnings of the companies that people buy stocks in. It all works together. So yeah, it's kind of interesting.
Wow. Yeah, I mean, just to point out those numbers, look at, if you don't mind sharing it again, look at the spike during the Great Financial Crisis.
Yeah, I'll pull it back up. The great financial crisis. What interested me, I didn't really. I thought we'd see foreclosures and bankruptcies, you know, kind of in sync and then surging during the great financial crisis together, which they did. But prior to that period, there were a ton of bankruptcies in the early 2000s,
There were.
2003,
Look at all the
4.
bankruptcies in the early 2000s.
Yeah.
Yeah.
I wonder, part of me wonders if that was legislative, that bankruptcies were legally more favorable and some type of law change. There's got to be some reason because, sure, there was some economic distress during that time, but not like the great financial crisis, just, 3, 4, 5, 6 years later.
Yeah. Interesting. So I want to preface this next chart by saying, listen, I know not everyone is born on the same base, and there are people that do better than others, and people that do worse than others. I completely get it. But this chart from this is from Arthur McWaters on Twitter.
That's a new one to me,
Um,
Arthur McWaters.
I know, right? And the actual source is the World Poverty in Absolute Numbers. There's a whole bunch of sources at the bottom. Ourworlddata.org. Bunch of data compiled together. But basically, Arthur says population has grown 9 times in 200 years while poverty trends to zero. People act as though capitalism is a zero sum game, but it's actually the only system that creates positive sum outcomes. The average person today is far richer than most kings in days past. That was fascinating. And basically, what this chart shows is world population living in extreme poverty from 1820 to 2015. So the data is a little bit dated, but basically showing that extreme poverty is defined, and this is important, extreme poverty is defined as living at a consumption or income level below 1.90 of international dollars per day. And international dollars are adjusted for price differences between countries and for price changes over time, aka inflation. So really taking everything into account here to say, okay, as a whole, as a percentage, how are people doing people doing today across the world versus history? And basically what it's showing is the number of people in extreme poverty, um, the number of people not in extreme poverty versus the number of people in extreme poverty is really, really separating, with the number of people living in extreme poverty drastically decreasing, really since it looks like the year 1960, and the number of people not living in extreme poverty is really increasing since the year 1960. So basically showing that, listen, while no system's perfect and nothing's perfect today, and there are problems, and everyone faces their own adversity, some more than others. Really, when you look at today compared to other centuries and other decades, the average person is doing much better than they would have been doing in the 1800s or early 1900s or even the mid 1900s, and definitely if you go back further prior to the 1800s.
Yeah. And it's hard for us to see that. I mean, we're accustomed to our most recent experience, the world in which we live and exist. And yet, when you look back, you think these numbers that bear it out, but you think life was definitely generally harder for more people 100 years ago, 200 years ago, even 50 or 60 years ago. And I think we don't appreciate this enough. And you're right, there are people still in very sad situations. We're not minimizing that. I mean, but the truth is, there's the old sarcastic quote, capitalism is the worst form of economic engine except all the others, right? It's got all these flaws and warts and problems, but versus all the other forms we've seen, it pretty much is the most optimal one for the most people.
And that's why I brought this up too, is because I've been hearing a lot of, and I get it. We have problems today. I get it, but I've been hearing a lot of, oh goodness, this is some of the darkest times, and
Yeah.
it's a shame we have to be alive during this time. And this is just actual hard data showing. I think the average person would probably rather be alive during this time than other points in far back in history.
Yeah.
You know,
We're talking about
not just
eras. We're not
not
talking about
just
the
on the
last.
poverty line, but
Yeah.
in terms of medicine, in terms of all the
Yes.
luxuries we live with today. I think if you brought someone from the year 1850 to today, they'd look at it and go, "You guys have it pretty good," you know?
I know, but we're human, so we have a hard time seeing that sometimes. We're all guilty of that. Me too.
Recency bias. I get it.
Yeah, yeah. All right, so this I found was pretty cool. It's actually a CNBC article, but I've been meaning to share this for a while. So, retirement savings lost and found helps retirees track down old 401ks and pensions. How it works. So basically, there's a website. It's lostandfound.dol, David Oscar Larry .gov, G-O-V. And if you go there, you can log in and you can search their database, the Department of Labor's database, for old 401k or pension plans. We hear all the time from people, I used to work at a company. I think I had a 401k there, but I'm not sure. I moved since then. I haven't seen a statement. Well, this is a way to track it down. Just go to lostandfound.dol.gov and search. And if you have something that's 401k or a pension, something under the purview of the Department of Labor, you'll probably be able to find it. Couple of thoughts on this. So the fact that, and they say here of the 236,000 and change unique visitors who logged onto this website since its launch in late December 2024, about 30% found an old 401k, pension, or other workplace plan.
It's a pretty good number.
I mean, the fact that a third of the people checking this website found retirement money that was theirs is a ridiculously high percentage. I mean, go check, because 30% of the people found money there, which is shocking. The other thing that I was thinking was, this covers plans or monies that the Department of Labor oversees, but there's a lot of money and accounts and kinds of things that you may own or someone you care about may own that you don't know about, that you can find or potentially find on another website, and it's simply unclaimed.org. Unclaimed.org. Go there. Also search for assets that you may not realize that you own that you didn't know were there. So if you have questions about this, you guys can always get in touch with us. But unclaimed.org is another hack to keep in mind.
That's really helpful, because I have met with so many people who have scattered 401ks, 403bs, 457s across different providers, and then also those providers will transfer them to others when let's say a company, an employer or business wants to switch 401k providers, and then they really have no idea where their plans are. They, number one, haven't worked at that employer in forever, and now the old provider, the 401k provider they used to use, is not their 401k provider. The 401k literally got moved. So
It's
that's
easy
an
to have
incredibly
happen.
useful tool, and yeah, if you guys have questions on that, please don't hesitate to ask us. All right. So tax season. Tax season ended almost a week ago now. Thank goodness.
Oh, you're bringing it down with tax stuff here, huh? Oh, no, this
Yeah,
is good
well,
news. I see.
a little recap. So this is from Medora Lee. Tax refunds climb ahead of April 15th IRS data shows. So this article was written on April 13th, 2026. So 2 days prior to tax day on April 15th. The number of tax returns the IRS has received so far for this tax season continue to lag last year's pace, but refunds are up more than 11%, the IRS data shows. The average refund through April 3rd was $3,462, up 11.1% from $3,116 at the same time in 2025. While total returns received fell 1.6%, the IRS said total returns received was just over $99.8 million, down from more than $101.4 million a year ago. Given the earliest filers tend to be the lowest income, refunds in the final week to the April 15th deadline, the average payout could get another small boost, analysts said. So basically saying that, hey, refunds are up this year. That should be encouraging for people who are facing high inflation, slowing job market. Should be a nice little boost for tax filers.
That's good. Yeah, good news. Taxes are boring, but getting a refund's not boring.
And then one more piece of data from this year's tax season. So average income tax rates. This is from First Trust Advisors and the IRS as well. This is actually the most recent data. This is only from 2023, so this is a little bit dated. But
It'll be the same today.
Highly progressive nature of the federal income tax system. Individuals in the top 1%, which means those with an adjusted gross income of $675,602 or higher, paid an average of 26.3% of their income to the federal government. Meanwhile, those in the bottom 50% earning $53,800 or less had an average income tax rate of 3.7%. Put differently, the top 1% faced an average tax rate more than 7 times higher than the bottom half of all taxpayers. I only bring this up because, again, not getting political, but when people refer to, well, the rich have to pay their fair share, they do pay their fair share. At least they have been, it seems like, based on the data.
Yeah, I mean, people have different opinions as to what the fair share is. We have a progressive income tax system in this country where the better you do, the more you pay. And then some people argue, well, people should pay more. And I don't know. At some point, you push people away and they move out of the country, like we're seeing with a lot of states right now that are raising their tax rates or throwing in wealth taxes. So you got to watch that. I mean, there's a balance there you want to strike where successful people both get rewarded, but also help people who are not as successful. But it's a real difficult balance to maintain. You can't push it too far one way or the other.
Well, I'm glad you brought that up because I also had this chart from the Bureau of Labor Statistics. State private job growth from January 2020 to January 2026, basically saying, well, looks like job growth is trending upwards in the states that have lower tax rates, although New Jersey is on this list of states with positive job growth in those 6 years. But basically the top 5 states with positive job growth from January 2020 to Jan 2026 is Texas, Florida, North Carolina, Arizona, and Tennessee, all pretty tax favorable. And the 5 at the bottom with
losing the most private
state
jobs.
Private job decreases essentially in those 6 years are New York, Massachusetts, Vermont, Oregon, and Hawaii.
Yep. Yeah.
So basically saying, what you just and basically saying what you just said is very accurate. Where eventually, if you press people too hard, they will just establish permanent residency in another state for tax purposes if that state has lower tax rates. It just will happen. And that will increase job growth in that state.
I mean, right now, our team is actively helping at least 3 clients with their transitions out of higher tax states. The one I talked to this week is in California, and being motivated by the fact that there's going to be a business buyout, and this person's going to receive a large payout from that business buyout that they run the business, and it's not happened for 3-4 years, and they really don't want to pay 10-11% in state taxes to California, so they're moving. So we see this anecdotally, and this is the broader statistical representation of it. But yeah, you push people too hard on the tax thing, they'll make a decision to not pay the tax by leaving you. You also go the other way where you don't tax successful people enough, the underlying foundation of society crumbles too. So it is a real balance.
Exactly. It's a fine line to balance. It really is, because you want the high earners to pay their fair share in taxes, absolutely. So that way you can support the economy of that specific state. Absolutely. You just don't want to do it to the point where they end up leaving the state.
Yeah. You're going to hurt yourself more than help yourself when you do that.
Yeah.
I don't have any more. You got any more? I just got something I've been watching, but any more?
I got. Do I have anything else? No, no.
No?
Actually, I thought I did. That's it.
All right. So I started watching. I don't know. You usually see stuff before me, so I'll be interested to see if you've seen this or known of it. But I started watching this. Now, there's a whole series, The Men Who Build America, but this one's The Frontiersmen, which is I love anything about the
I
Frontiersmen.
was gonna say this is a very Rick Wagner
Yeah,
show.
Mountain Man Jim Bridger isn't in this one, but still, I love it. It's a History Channel docudrama, but it's on Netflix if you want to watch it. That's how I found it was on Netflix. It's 4 episodes. They're about 2 hours each. Very watchable. It's they did it. Some docudramas are really poorly put together. This is actually somewhat cinematic for a docudrama. 4 episodes. In each of the four, they talk about a different frontiersman type person. Daniel Boone is number one. Excuse me. Tecumseh, the Shawnee leader, is number two. Andrew
Yes.
Jackson is the number three, and Davy Crockett's number four. So I haven't finished it. I'm only about halfway through. But The Men Who Build America, Frontiersmen on Netflix, really, really great series if you like that kind of stuff. There's action. It's a little gory at times, but not too bad. But really fascinating. I'm learning a ton about history and this country that I didn't know. I thought I'd read a lot of books about this stuff, but they really have great stuff in there. Leave it to the History Channel. They've always put good stuff together. But great show.
I'll check that out because I need a new show. I really don't have any shows or books to recommend. I've been busy, but that's one I'd like to check out.
Yeah, you'd enjoy it.
Absolutely.
It's worth it.
Yeah.
Really, really
Yeah.
worth it. Beautiful panoramas they have in their landscapes. They really took advantage of. Listen, these people were in the middle of nowhere. Let's make sure it's as beautiful as possible for most of these shots. So really cool.
And it's funny because you and I have both been out there, and it can't be that hard to recreate that because there's still so much open, gorgeous land out there
Yeah,
without a piece of human civilization in sight. So
yeah,
yeah, yeah,
yeah.
that's awesome. All right, well, we'll catch you guys next time. Please remember you can subscribe to us on Spotify as well as YouTube, and check us out on our website as well. We'll see you guys next time. Thank you.
See you, everybody.
The Capital Clarity podcast is presented by FA's Keith Wagner, AA, MS, Financial Advisor, and Rick Wagner, CFP, Senior Vice President, Wealth Management. This podcast is for informational purposes only and is not intended to be taken as financial advice. All opinions expressed are of the hosts and do not necessarily represent those of Raymond James. Opinions are as of this date and are subject to change without notice. Investing involves risk, and you may incur a profit or loss regardless of strategy selected. Prior to making an investment decision, please consult with your financial advisor about your individual situation. 2003 South Easton Road, Suite 100, Doylestown, Pennsylvania 18901, 267-742-3455, Raymond James and Associates Inc., member New York Stock Exchange SIPC. The S&P 500 is an unmanaged index of 500 widely held stocks that is generally considered representative of the U.S. stock market. The Dow Jones Industrial Average, DJIA, commonly known as the Dow, is an index representing 30 stocks of companies maintained and reviewed by the editors of the Wall Street Journal. Inclusion of these indices is for illustrative purposes only. Keep in mind that individuals cannot invest directly in any index, and index performance does not include transactions, costs, or other fees which will affect actual investment performance. Past performance does not guarantee future results. 529 plans come with fees and expenses, and there is a risk they may lose money or underperform. Most states offer their own 529 programs, which may provide benefits exclusively for their residents. Please consider whether the state plan offers any tax or other benefits. Tax implications can vary significantly from state to state.